Hello and welcome to International Economics. Now we're going to cover Chapter 11, namely the foreign exchange market. So the foreign exchange market is basically a virtual market in the sense that these days is dominated by online-based infrastructures that facilitate the exchange of different currencies. In some is an organizational setting within which individuals, businesses, governments, and banks buy and sell foreign currencies and other debt instruments. The foreign exchange market, also known as the FX market, is the largest and most liquid market in the world. Daily turnover is about $5 trillion and is dominated by four currencies, primarily the US, followed by the euro, Japanese yen, and the British pound. Now we are at the website for the Bank of International Settlements. This is pretty much an organization where the members are the central banks around the world and compiles data supplied by each one of them on several types of transactions, including the foreign exchange market. So every 3 years we have the survey of foreign exchange and over-the-counter derivatives market. The last one was conducted in 2016. We're going to go to the detailed tables to access the information. These links are provided below the video. So on page 76 of the report, 76 of the PDF file, or 72 of the de facto printed report, we have the over-the-counter foreign exchange turnover by currency within the period of April 95 to 2016, the daily averages. So in 1995, the average turnover was about $981 billion worth of transactions involving the US dollar, and the US dollar amounted to 83% of all the transactions in the foreign exchange market, followed by the Japanese yen with $291 billion worth of transactions, accounting for 25% of the overall amount, the British pound with 110 billion, accounting for 9%, the Australian dollar with 31 billion, just 3%, the Canadian dollar with 40 with 3%, and the Swiss franc with 85 billion, accounting in those days for 7%. You see that there was no data for the euro. That's why the euro is just introduced in 2001. And it starts with about $470 billion worth of transactions, accounting in those days for 38% of the total. And the most recent data, you can see the significant increase. The most recent data points to $4.4 trillion worth of transactions involving the US dollar, accounting for 88%, $1.6 trillion involving euros, and that accounts for 31%, $1 trillion for the Japanese yen, 22%, the British pound, 649 billion, accounting for 13%, then the Australian dollar with 7%, Canadian dollar with 5%, Swiss franc with 5%, and the Chinese yuan with 4%. Note that the Chinese yuan is an emerging currency because it was not freely transacted until recently. There used to be significant constraints in the amount of Chinese yuans that could be traded in foreign exchange markets imposed by the Chinese government. But recently they decided to allow for more transactions involving their currency, being Dubai now, for example, recently allowed to trade in Chinese yuans as well. And what we see is, for example, since 2010, accounted to merely 1% of all the transactions, with $34 billion worth of Chinese yuans being transacted. In 2013, that amount went up to 120, increased by a factor of 4 almost, and almost doubled from 2013 to 2016, continuing its emerging path of becoming one of the most important currencies. Now, it's also worth it to compare what was the total amount traded on a daily basis. So in 1995, the total amount of transactions in the foreign exchange market accounted for about $1.2 trillion daily, and these days is about $5 trillion daily. The relevance of the foreign exchange market is increasing and is linked to the boom in globalization as well. As more countries participate in the globalization process, more goods and services are transacted, and the exchange of the currencies is recorded here in the foreign exchange market. So the foreign exchange market is primarily dominated by the big banks, transactions among the commercial banks and their commercial customers. Whereas, the average Joe, when he wants to, for example, do vacations in Mexico and needs some Mexican pesos, uses its bank as intermediary, which in turn, depending on the size of the bank, either deals with another bank or goes directly to the foreign exchange market. So typically you see lower prices in the big banks for foreign exchange market and higher prices in the smaller banks because of the number of intermediaries they use. Now, there are different types of transactions in the foreign exchange market. The outright spot transactions, as the name implies, they are made right now on the spot. This is the simplest form. An individual goes to the bank and says, I want this amount of foreign currency. What is the price that you give me? And the deal is settled there. Then there are forward transactions, and these are kind of future contracts in the sense that we agree today upon an exchange rate that is going to be used to make this transaction sometime in the future. So it's a kind of hedging your position, a kind of insurance against currency exchange fluctuation. And there are different types of forward transactions that we're going to learn about soon. A third type of transactions are called currency swaps. It basically is an agreement between two entities on converting one currency into another at a predetermined point in time. And this also demands that there is going to be a reconversion back to the original currencies each entity involved in the deal had at the beginning. So, for example, a firm needs euros right now, and it knows another firm that has euros. So they do, hey, can I have those euros now from you at a fee, and I'll give it back to you in like 3 months. Let's exchange your euros for my dollars, and in 3 months I give you back the euros and you give me the dollars to satisfy currency needs in the short term. Of course, this involves a cost, and that's why it is made, for profiting with this transaction. Table 11.1 shows you the average daily volume of exchanges using the different financial instruments in the foreign exchange market. So spot transactions in those days accounted for about $319 billion, accounting for 45% of all transactions. Foreign exchange swaps 221, 31%. Forward transactions 109 billion, 15%. Foreign exchange options 66 billion, 9%. Now let's look at the recent data from the Bank for International Settlements. And on page 5 of the PDF we were just looking at, you have here the breakdown of spot transactions, outright forwards, foreign exchange swaps, currency swaps, and foreign exchange options. And you see that the foreign exchange swaps are now taking a big chunk of the transactions done. The spot transactions still have a huge relevance, but are no longer the primary instrument used. There's more planning, and therefore the foreign exchange swaps are now here, accounting for a significant higher volume than spot transactions. So this shows the increased sophistication in the participating agents by not going naked, meaning without hedging, but preferring now some kind of protection against their portfolios of foreign currencies, portfolios and needs. Now you see here that there is data for currency swaps and foreign exchange swaps. Foreign exchange swaps is what is described in the textbook. Currency swaps is a newer financial instrument. Basically, the difference is this is an exchange of cash flows, a series of cash flows, whereas the foreign exchange swaps are the traditional exchange of one currency for another at a certain point in time. So it involves just two transactions, they exchange now and they exchange back, converting in the future. Whereas the currency swaps involve several transactions because it's associated with several cash flows. This is typically used by banks that have loans in, for example, US dollars. Other banks have loans in British pounds, and they decide to exchange those loans. So it's a more sophisticated instrument. The foreign exchange swaps are the traditional. The interbank trading is dominated by large commercial banks because typically the minimum is 1 million currency units. The retail banking, that's associated with the banks dealing with their customers, which typically need fewer amounts of currency. So the big banks buy in the foreign exchange market and then sell it to their customers. In 2009, the top 10 banks dealing in this foreign exchange market was the Deutsche Bank, accounting for about 21% of the exchanges. The Union de Banque Suisse, so the Swiss bank with 14.48%, Barclays Bank from England 10.45%, the Royal Bank of Scotland with about 8.19% of all foreign exchange transactions, and then come the American banks, Citi, JP Morgan, and then the Hong Kong Banking Corporation, Goldman Sachs, Credit Suisse, and Banque Nationale de Paris at 2.26. So you can see that the foreign exchange market is dominated by foreign banks. And that's because the US dollar accounts for such a large portion of all transactions. Whereas in the other countries, the banks need dollars to conduct international transactions. So how can one profit from participating in the foreign exchange market? Well, like any other market, buy cheap, sell dear. So you need to be familiar with the terminology of the codes. So bid rate is the price that the bank is willing to pay you for a unit of foreign currency. The offer rate is the rate at which they are willing to sell you. So obviously the offer rate is going to be greater than the bid rate, and the difference is what we call the spread, which is a proxy for the profit margin that the bank is benefiting. Now you should be aware that in addition to this spread, you typically also have transaction fees that add costs to the exchange of one currency to another. And every bank has their own policies, so you should pay attention to those details when engaging in the exchange of foreign currencies. Now, when it is reported in the media, they typically do not post the bid and offer rates. What they do is to report the mid-range between those two rates. So for example, we have here data that was published by the Wall Street Journal in March 13, 2009. And in those days, let's find here, for example, the British pound. You have data for Wednesday and data for Tuesday. These two columns are reported in US dollars that you need per unit of foreign currency. So we're talking about pounds. So it will report the number of dollars you need to buy 1 pound. And the last two columns report for the very same days the inverse of that code. What is that? Well, is the number of pounds that you're gonna get per each US dollar. So the traditional reporting is done using what is the price of 1 unit of foreign currency in terms of our currency. Or in other words, how many dollars do I need to give up in order to buy 1 unit of that foreign currency? So for example, you have here for the British pound, on Wednesday, one needed to pay $151.39 per pound, and on Tuesday, the previous day, was $152.69. So what you can see here is that on Wednesday we needed to give up fewer dollars in order to get the same 1 pound. Therefore, the dollar appreciated from Tuesday to Wednesday. It appreciated because you need to give up less of your currency in order to get 1 unit of the foreign currency. Conversely, you could also say that the British pound depreciated. It will be synonymous. The British pound depreciating against the dollar is the same as to say that the dollar appreciated against the British pound. Now, this is the spot transaction code. You also have, because of the high volume of transactions with this currency, you also have codes for the 1 month forward contract, 3 months, and 6 months forward. So on Wednesday, the code for establishing today a contract where the currency is delivered 1 month from today was you need to give up $1.5137 per each British pound. In 6 months, so negotiating today a contract that delivers the currency in 6 months, you needed to give up $151.31. This gives you an insight into the market expectations about the future exchange rate. So what they predicted at this point was that the dollar would continue to appreciate against the pound, because as you go into future months, the amount of dollars that one needs to give up in order to buy a pound gets smaller and smaller. So corroborating the expectations of a continuous appreciation of the dollar against the British pound. Let's look, for example, at data from Canada. So on Wednesday, one needed to give up 85.06 cents of a dollar to buy a Canadian dollar. And 6 months later, for currency to be exchanged 6 months later, if you would do a contract on this Wednesday, the code was 0.8517. So in relation to the Canadian dollar, the US dollar was depreciating because it is expected that in the future you would need to give up more US dollars to buy a Canadian dollar. So this is an interesting case because you see that the currency can simultaneously appreciate and depreciate depending on which trading currency we are talking about. So against the British pound was expected to appreciate the dollar, whereas against the Canadian dollar, the dollar is expected to depreciate. This highlights the importance that the currency exchange market is comprised of many different currency pairs. And when one says the dollar is appreciating, it does not mean that it's appreciating to every single currency necessarily. We need to pay attention to which currency pair we are talking about, because it could be appreciating against a currency, like for example the British pound here, and depreciating against another one, like the Canadian dollar. Now we're going to look into cross exchange rates. So we're going to do a numerical example to illustrate this concept. Okay, so let's use table 11.3 to talk about cross exchange rates. Note that for Wednesday, so let's focus on the Wednesday data. and the British pound. Note that the exchange rate that we are given is the number of dollars per British pound and is set at, for the spot rate, $1.5139. So that's the amount needed to buy 1 British pound. If you want to figure out the inverse, which is, so how many pounds do I need to buy a dollar, you just have to do the inverse of that code. And this gives you 0.6605. This is the number of pounds that you need to buy $1. Okay, coming from table 11.3. And that's the number you have over here, expressing how many pounds you get per US dollar. Now, from the same table, note that we have the spot rate for the Swiss franc. Okay. And that number is given over here, 0.9029 of a dollar. So you need 0.9029 dollars to buy a Swiss franc. So this is the same as if I want to figure out how many Swiss francs do I need to buy a dollar, just do the inverse of that. So the number of Swiss francs is 1.1075 per dollar. Now let's say that I want to figure out how many Swiss francs do I need to buy a pound, so a cross exchange rate. Which codes do I have? Well, I know how many dollars I need per Swiss franc, and I know how many dollars I need to buy a pound. And I'm trying to figure out how many Swiss francs I want to buy a pound. So what you do is you put the dollars per pound on the top. Note that's that 1 year. And on the denominator you put the dollars per Swiss franc. Okay? And the result is going to give Swiss francs per pound. Okay? So note, you want to know Swiss francs per pound. So you put Swiss francs on the denominator and the pound code in the numerator, both related to the same currency. In this case, we're using the dollar as the reference. Okay. So the result would be dollars per pound, 151.39. And dollars per Swiss franc, 0.9029. This would yield 1.5757. So that's the amount of Swiss francs you need to buy a pound. Or you can compute the inverse of this. Let's say you want to figure out how many pounds you need to buy a Swiss franc. So you would use the exchange rate dollars against Swiss franc divided by the exchange rate of dollars against the pound. So this will give you how many pounds per Swiss franc. So 0.90.29 divided by 1.5139. which gives 0.5964 pounds to buy a Swiss franc, which is exactly equal to the inverse of the previous quote of 157.57. So you could compute just the inverse of that, or compute it the traditional way, and you get the same result. How many pounds do I need to buy a Swiss franc? 0.5964. So that's how you compute cross-exchange rates. Then Carabao proceeds by going deeper into the differences between the spot market and the forward market. So spot market is transactions done right now. Forward market involves an exchange in the future. And among the instruments available in the forward market are the forward contracts and the futures contract. What is the difference? Well, the forward contract is a tailored contract. So you call your bank and you say, hey, I need 350,000 euros to be delivered to me like 3 months into the future. And the bank makes a contract specific to your needs. Whereas the futures contract is standardized. Every currency has their minimum amounts that can be traded. And for example, if you want 350,000, but the minimum in the futures market is like 1,000,000, you cannot buy. So if you need like 1,050,000, it's already not appropriate for you because you can only buy 1,000,000. Right? So you could buy 1,000,000 there, but then you have to buy 50,000 on the side through a forward contract. So the key difference is that the forward market is tailored to the specific needs of the client, and the futures contract is standardized, lots of currency. Let's look at the Chicago Mercantile Exchange for a real-world example. So we are at the Chicago Mercantile Exchange. The link is also provided below your video. And there are many different sub-markets. You can trade future contracts in agricultural commodities, energy, equities, foreign exchange. That's what we are interested in. You can also make bets on interest rates, metals, options, even the weather. So now we are at the foreign exchange quotes. And here are some examples. So you have future contracts involving the euro currency, the Japanese yen, British pound, and so on. Let's look at euro. So currently, the Chicago Mercantile Exchange is offering future contracts where the euros are delivered in July at $1.1175 per euro. This is the amount of the change compared to the prior settlement. This is how much it opened that day. What was the highest paid on that day and the lowest? So you see some variation. And there were 16 contracts transacted. Now look, for August, the quote is 111.85, so you need to give up more dollars. And for September, 1.12. So the market expects the dollar to continue to depreciate against the euro because you need to give up more dollars to buy 1 euro. Now in this day, there were no contracts sold for delivery in October or December, but we have data from the prior settlements. So the curious part here is the continuous depreciation of the dollar against the euro. And if you want to buy today a contract for delivery of euros in June of 2022, the quote is $1.24185 per euro. Now we are in the contract specifications for these future contracts. So these are standardized to lots of 125,000 euros. No more, no less. So you can buy 2 lots, which would amount to 250,000 euros. Or you can buy 8 lots, which would amount to 1 million euros. So this is the standardization we were talking about, as opposed to forward contracts where you can tailor your needs. So the following slides cover what we just saw at the Chicago Mercantile Exchange. Next, in addition to forward and future contracts, forward foreign exchange market instruments also include options. So what is the difference between an option and a future contract or a forward contract? Is that the option, as the name implies, does not forces you to comply with your end of the agreement. What do I mean? In a forward contract or future contract, you establish that you're gonna buy that currency in the future at this predetermined exchange rate. So when that future date comes, you have to do your part of the agreement. Otherwise, you're breaking the contract and therefore you can be sued. With the option, what you are acquiring is the option to exercise the right to buy or sell in the future at an exchange rate determined now. So if it's not in your interest to exercise that option in the future, when the expiration date comes, then you can freely not exercise it without penalties. So we have call options and we have put options. The call option is the right to buy, and the put option is the right to sell. Other related terminology is the strike price, which is the price that the option is guaranteeing you as the exchange rate, and the premium, which is the fee you have to pay for contracting that option. So the forward contracts is a broad name that is given to 3 categories of instruments related with the future exchange of currency. Forward contracts are customizable. They are the future contracts, which are standardized, and are these options contracts, which are also standardized. But the forward and future contracts do not give you the option to get out of the contract, whereas the options gives you the option not to exercise the right that you bought. Now we're going to look into a simple model of exchange rate determination, and I will explain it to you by doing a derivation by hand of these graphs. Now let's look at the model of exchange rate determination. This is a simple supply-demand model. Could be talking about potatoes, but in this case we're talking about foreign exchange. And in particular case, let's just replicate the graph here. We are looking at the amount of dollars per pound versus the quantity of pounds. So that's the exchange rate in nominal terms, and this is the quantity of pounds traded, the price of those pounds and the quantity of pounds. And we have a traditional supply upward sloping curve saying that people are willing to sell more pounds the higher the price is, and conversely the demand fewer pounds the higher the price is, or demand more pounds the lower the price is. The invisible hand brings the market to an equilibrium at a point where the demand intersects the supply, and that gives us the insight, let's call it point 1, into what is the prevailing equilibrium in this market in terms of price and quantity. So following the picture, $2 and 3 billion pounds exchanged. Now let's say that there is some product from the UK, like a Rolls Royce, that becomes increasingly appealing to US consumers, and they demand more Rolls-Royce from England. So therefore, they have to pay in pounds. That would lead to an increase in the demand for pounds because we are buying more British-made products, and leading to a second equilibrium associated with that higher demand for British products comes an increase, let's say this is 5, an increase for the currency of that country. And at the same time, given that all else is equal, namely the supply of pounds, then pounds become more scarce, therefore more expensive. And let's say that this goes all the way to $3. So if there is an increased demand for British-made goods, the demand for British pounds goes up, leading to a depreciation of the dollar. This is a US dollar depreciation. Why is depreciation? Because you need to give up more dollars per each pound. Conversely, let's say that we enter in a trade dispute with England and we buy less British goods. What would happen in that case? The demand would decrease. Assuming we start at the same point, and instead of experiencing an increase in demand, we observe a decrease in demand, then fewer pounds would be transacted. Let's say that it goes down to just 1 billion pounds being transacted. And since there is a lower demand for British pounds, we would pay less for each pound. And this would mean then a US dollar appreciation. Why appreciation? Because we're giving up less dollars in order to buy each pound. Now, what if there are changes in supply? Let's draw the model again. This is the quantity of pounds. This is the exchange rate of pounds expressed in dollars. Equilibrium at $2 per pound. And we have a quantity of 3 billion pounds being transacted. Initial equilibrium. Now, let's say that British citizens are willing to invest in the US economy more than before. So they rush to the market trying to get rid of their pounds and obtain dollars. So what we would observe in this case would be an increase in the supply of pounds, and this would lead to more pounds being transacted since the British are getting rid of them. Let's say these go up to 5 too. But the price would go down in this case. So what we would observe in this case is a US dollar appreciation. Because the supply increased and now we are paying less dollars per pound. Now let's assume that British investors become increasingly more optimistic about British investments and are not so eager to get rid of their pounds for dollars. So in that case, the supply would contract. Let's call it S3. If the British are less willing to get rid of their pounds, leading to this 0.3 equilibrium, intersection of the new supply with older demand. And as a result, there will be fewer pounds transacted. And as they became scarcer, they will become more expensive. And in this case, we will have a US dollar depreciation. Depreciation because we now have to pay more dollars to get £1. Note that you could also interpret this as a British pound depreciation because it's synonymous to US dollar depreciation. And you could interpret US dollar appreciation as a British pound depreciation. Obviously, we are talking just about this currency pair, dollar versus the pound. Now, what if both curves move simultaneously? So $2 and £3 billion being exchanged. So let's say that we have a case that the supply increases from S1 to S2 and the demand increases as well. Well, let's say it's just a little bit. So what's going to happen? The intersection of the latest supply with the latest demand occurs at the point beyond 3 for the quantity. Let's say this is 5 again, for the sake of simplicity. But the price goes down. Let's say this is 180. So the equilibrium price would end up below the initial one. But what if the increase in demand was such that actually we end up over here? Let's call this D2 prime. If that was the case, then we would end up at this intersection point, corresponding to a price, let's say, of 280. The quantity would be even higher. Let's say it's 7 here. So what we know for sure when both curves change? In this case, they were both increasing. So we know for sure that the quantity is going to go up, but it's ambiguous what is going to happen to price. Could go up or down. So here is ambiguous in relation to price, but in terms of quantity, we know it's going to go up. The magnitude of the change, we don't know for sure, but we know that it's going to be above the initial level. So I'm using this case to illustrate that when both curves change, we need to pay attention to which variable we know for sure, in this case was quantity, and which variable is going to be ambiguous. So the best way to do that is always to plot the graph and check out with different jumps in the demand or in the supply which variable turns ambiguous and which one you know for sure the direction of change. Just like you used to do in your Principles of Economics courses. Table 11.6 summarizes the advantages and disadvantages associated with a dollar that is appreciating or depreciating. So the advantages of having a dollar that is appreciating. Well, the advantages are primarily at the level of consumer prices on imported goods. So the stronger the dollar gets, the cheaper it is for US consumers to buy foreign goods or to go in vacation. That's what Carbo highlights here in point 3. It becomes cheaper to travel abroad. Another side effect is that as the consumer prices get lower, because a significant portion of the typical basket of goods is comprised by imported goods, then a strong dollar contributes to a lower inflation rate in the US because the prices of foreign goods are cheaper now. What about the disadvantages? Well, a primary disadvantage is for US exporting firms. Now that the US dollar is stronger, it means that foreigners have to pay more of their local currency to buy the same dollar priced good. And therefore, US exporting companies lose competitiveness in foreign markets, and one would not be surprised if the amount of exports decrease. Another disadvantage is that US import competing firms now are going to face an increased competition by foreign producers because the foreign goods arrive to the US market at a lower US dollar price, and therefore makes it harder for the US firms to compete with the foreign firms. The third disadvantage highlighted here is that probably going to see fewer tourists coming to vacation in the US because as the US dollar becomes more expensive, they will have to give up more money to do holidays in the US. What about having a depreciating dollar? Well, it's pretty much the mirror image of what we just discussed. If the dollar gets weaker, US exporting firms become more competitive in foreign markets because foreigners have to give up less of their home currency to buy a US product. Second, firms in the United States now are going to observe that their foreign competitors place their products in the US at a higher price, so alleviates foreign competition to a certain extent. And more tourists are expected to come visit the United States because if the dollar is weaker, then it's cheaper for them to come visit the US. What are the disadvantages? Well, the US consumers now are going to face higher prices because as a significant portion of their basket of goods and services is comprised by imports. Now those imports are going to arrive more expensive, so it's going to contribute to a higher inflation rate in the US. And the US citizens are going to find it more costly to travel abroad. So table 11.6 briefly summarizes the advantage and disadvantage of having a strong or weakening dollar. And as you can see, there are trade-offs. There will be winners and losers in each one of the scenarios. Then Carabao proceeds by talking about exchange rate indexes and the difference between the nominal exchange rate and the real exchange rate. So I'm going to derive this formula by hand to better explain this concept. So on slide 34, you are given a formula that gives the relationship between the real exchange rate and the nominal exchange rate. Let's use sigma for the real exchange rate and small e for the nominal exchange rate. PF stands for the price of the foreign product, could be a specific product or a typical basket of goods, like an inflation index. And in the denominator, we have the same price index, but with respect to the home country. So this is the formula expressed in absolute values. Note that taking total differentiation, we can also express this formula in percentage changes. And doing that, we would find that the percentage change, so this is the mathematical notation for percentage change in the real exchange rate, it's equal to the percentage change in the nominal exchange rate plus, not multiplying, plus, because the derivative of a multiplication is summation, the percentage change in the, what is on the top, foreign prices, minus because the derivative of a division is a subtraction, minus the percentage change in the ohm price. Now, from principles, we know that a percentage change in prices basically equal to the inflation rate. We typically use pi to denote the inflation rate in economic models. So we can rewrite this formula as the percentage change in the real exchange rate is equal to the nominal exchange rate plus the inflation differential between the foreign inflation and the home inflation. Or we could solve for the nominal exchange rate, and we can have that the difference between the home inflation and the foreign inflation plus the percentage change in the real exchange rate gives you insights into the movements of the nominal exchange rate. So you can look at the formula like this, or as for the real exchange rate. Now we have a theory called the purchasing power theory. The purchasing power parity theory that basically imposes the real exchange rate to be equal to 0. This is what we call the PPP theory. Okay. And if valid, if the purchasing power parity holds, or if we are told to simulate assuming that the purchasing power parity holds, then we would conclude that the percentage change in the nominal exchange rate is fundamentally driven by the difference between the home inflation and the foreign inflation. What does that mean? This simple theory basically says that if the home inflation rate is greater than the foreign country inflation rate, then we should expect a positive change in the number of domestic currency we pay for a unit of foreign currency. Basically meaning that if our inflation is greater than the foreign country, then our currency is going to depreciate. The opposite being also true. If our domestic inflation, our home country inflation, is lower than the foreign inflation, then the change in the nominal exchange rate will be a negative percentage change, meaning that we would give up fewer units of our domestic currency per unit of foreign currency. So if the change would be to go negative, then our currency would appreciate. So from here, you can conclude that if the percentage change is greater than 0, home currency depreciates. If it's less than 0, home currency appreciates. Because this means you're giving up more of domestic currency to buy 1 unit of foreign currency, for example, dollars per pound. And this means that you're giving up less of the domestic currency to buy 1 unit of the foreign currency. So numerical exercises, just like the textbook shows, is just plugging numbers for each one of these variables. The key issue is to interpret the result. Nonetheless, remember, these are the two fundamental formulas, one in relative terms, another one in absolute terms. This one is a kind of a shortcut But you still can use the original formula with absolute values to get the same answer. The valuable insight is when looking at it in percentage changes, we can make inferences solely by comparing the inflation rates, particularly if the purchasing power parity theory holds. Because if it doesn't hold, we need to know what's going on with the changes in the real exchange rate as well. Then Carabao shows you an example of the US dollar index against the major currencies that the US trades with. And you can see here nominal exchange rate index is different from the real exchange index. Let's look at the nominal. So in nominal terms, using the year 1973 as the benchmark, by 1980, the US dollar was worth about 12.6% less than in 73, 100 minus 87.4. By 84, it was worth 38.3% more than in 73. Right? So this first depreciation is due to the turmoil in the currency markets in the eve of the oil shock of 1973 and abandoning the gold peg that the US dollar had. Remember that President Nixon transformed the US dollar into pure fiat money. In 71, he signed the law. 72, he began the implementation. There was a lot of turmoil that ensued. Then Paul Volcker takes the helm at the Fed and increases the interest rate, the federal funds rate, tremendously, up to 17.5%. So you can imagine now we have the federal funds rate hovering about 1% as of June 2017, and compare that with the 17.5% in the early 80s. So the dollar appreciated a lot when the interest rate went up tremendously because it attracted a lot of foreign investment as well. There was such a high interest rate being paid on US dollar denominated deposits. And then you see that the path has been a continuous depreciation of the US dollar. So making it more difficult for US citizens to travel abroad, but on the other hand, better conditions for US firms to compete in foreign markets as well as to face foreign competition because the dollar on average got weaker. Let's look at more recent data because this one ends in 2008, just at the eve of the financial crisis. So this is another link available on Canvas next to the video, and it shows you the evolution of the trade weighted dollar index. Let's put this on the max. And so here is mirroring just what we saw in the table, the appreciation of the dollar up to 84 and then the decline up to 95. There's an appreciation up to 2002 and then coming down again up to 2008. And since then, there was this turmoil here up to 2011, but clearly since 2011, it has been appreciating. Okay? Still not as strong as in 1973, with 100 being the benchmark. Look here, index March of 1973. Because it's not as strong because it's still at 91.79, well, 91.8, whereas in 73 was 100. So this has been the evolution of the US dollar trade index, which is against a bunch of currencies, but let's look, for example, at the behavior against the euro, focusing on 2012 onwards. Or let's look at the max. So the maximum goes from 99 to nowadays. June 16, 2017. And note that this is expressed in the number of dollars necessary to buy 1 euro. Okay? So remember that the euro was launched in 2001, but was introduced as an accounting currency in 99. Okay? So it starts more or less at parity. Okay? It reaches parity here in early 2000s. And then the dollar appreciates. Look, by October 10, 2000, you only needed 86.82 cents of a dollar to buy 1 euro. But then it appreciated a lot against the euro. So making it easier for American firms to compete in European markets and making it difficult for European firms to compete in the US markets. Why? Look, in February, let's just pick one, but this is moving. So in April 14th of 2008, we needed $1.5827 to buy 1 euro. Okay? And nowadays, we need about $1.12 to buy 1 euro. So since 2008 up to now, the dollar has been appreciating because you need now less dollars compared to 2008 to buy 1 euro. Let's look at the Canadian currency, so the Canadian dollar. Note that here says Canadian dollars to $1. So basically it says how many Canadian dollars you get per each US dollar. Note the difference because the previous slide was giving you how many dollars you need to buy 1 euro. And here it's telling you how many Canadian dollars you get per $1. So let's put this on the max. The max comes all the way from 71. So here you can see that from 71 pretty much up to this peak of 2002, a trend shows continuous increase, appreciation of the US dollar against the Canadian dollar. By 2002, you would get about 1.60 Canadian dollars per each dollar. But at the eve of the crisis, for example, February 2008, it was pretty much parity, meaning that you would only get 1 Canadian dollar per each dollar. So the dollar depreciated in this case. And since then, we have a return to an appreciation path of the US dollar versus the Canadian dollar. And these days, you get about 1.36 Canadian dollars per each American dollar. So the paths are not identical. Again, showing that each currency pair behaves differently. This was the path for the euro against the dollar. This was the path for the Canadian against the dollar. And this was the trade-weighted index. Then Kerbau proceeds by illustrating how to do arbitrage, the concept of 2-point arbitrage and 3-point arbitrage, which I will do a numerical example to illustrate. In that example, I will also cover the premium and discount in the forward market. Now let's talk about the 2-point and 3-point arbitrage described on slide 37. So we're going to do the more complex one, which is the 3-point arbitrage, to illustrate it. So let's say you're walking down the street and you pass through 2 banks. You have, well, 3 banks. You have Bank A, which is offering a quote of dollars per euro equal to $1.20 per euro. And you walk down the street, you pass through Bank B, and you find the quote between euros and pounds of €1 per pound. Then you continue and you pass through Bank C and you see a quote of pounds per dollar equal to 0.90 cents per dollar. So how would you make a profit using these codes and assuming that there are no other costs, no transaction costs or taxes or whatsoever? Well, first step, buy pounds at Bank C. Per each dollar you get 0.90 pounds. So let's use as a reference that we are investing $1. Then whatever result we get, we just multiply it. So $10 will be times 10, and so on. Second step, convert pounds into euros at Bank B to get 0.90 euros. Note the code is parity. Per €1 you get a pound, so per £1 you get an euro. Per 90 cents of a pound you get 90 cents of an euro. Step 3. Convert euros into dollars at Bank A to get, so here it says that you're gonna get $1.20 per each euro. So I just want to convert 0.90 euros. So I have 0.90 euros. Each euro is worth $1.20. So I'm gonna get for these 90 cents $1.08. Thus, a profit of 8 cents per US dollar invested. The same is to say 8%. So that's an example of 3-point arbitrage because you do 3 transactions to make a profit. If you would make just 2 transactions, then that'll be a 2-point arbitrage. If you make 4 transactions, it will be a 4-point arbitrage, and so on. So this is just an example that relies on rationality of finding where to buy cheap, where to sell it dear. Even if you have to use some intermediary steps to achieve your goal of making a profit, that is arbitrage. Now let's look at evaluating if a currency is selling at a premium or discount in the forward market, and by how much. So this is the formula given to you on slide 40, which says that the currency is selling at a premium if this equation gives a positive value, or a discount if this equation gives a negative value. And what is the equation comprising? F stands for the forward rate, forward at 3 months or 6 months or 1 month, depending on the investment we are doing or the forward rate we are evaluating. And S stands for the spot rate, how much is the currency being sold at right now. So this first component is computing the percentage change, forward rate compared to the spot rate. And this second component here is annualizing that percentage change. So we have 12 months that a year has divided by the maturity of the instrument you are buying. So the number of months forward that instrument is. If it's 1 month forward, 3 months, 6 months, whatever. From table 11.8, looking at the codes from Wednesday, you are given that the spot rate for dollars per pound, it's 1.5139. Whereas if you want to buy the 6-month forward contract, a future contract or an options contract, the code associated with it is $1.5131 per pound. Okay, so how would we use the formula? So the premium or discount would be equal forward rate, so that's the 6 months forward, 1.5131 minus the spot rate, which is 151.39, divided by the spot rate, 151.39, times 12 divided by the 6 months. So you can see immediately from here that this is going to be a negative value. 151.31 minus 151.39 is going to give a negative value. The discount, and this number is going to give negative 0.001. The same is to say negative 0.1%. So the forward contract at 6 months is selling at a discount of 0.1%. If it was a positive, we would say the forward contract at 6 months is selling at a premium of plus 0.1%. So that's a simple formula to assess if the forward contract is selling at a premium or a discount. Another type of arbitrage is related to interest rate arbitrage. So you can make money not only by doing arbitrage in the foreign exchange market, dealing with currencies alone, but also exploring interest rates in different countries, in addition to currency exchange fluctuations. So it becomes a little bit more trickier because now you have 2 dimensions you're playing in, and that's what Carbao is explaining here. So put yourself in the mind of a US investor considering investing in the UK. So per each dollar invested, there is going to be a profit, an arbitrage in the interest rate, which is linked to the difference, how much more higher is the UK interest rate relatively to the US. And then we have to take into account the fluctuation on the value of the pound. So our extra return for investing in the UK instead of putting the money in the US bank is positively impacted by the interest rate differential, but negatively impacted if there is a depreciation of the pound. Because at the end of the investment, when you want to reconvert those pounds back into dollars, you're going to get fewer dollars for those pounds. Whereas if the pound during the time of this investment appreciates, then it's going to add to your profits. Right? So this is showing you that your return in investing in a foreign denominated financial security depends not only on the interest rate differential, but also on the currency fluctuation. If the foreign currency gets weaker, that is going to diminish your profits. If in the meantime the foreign currency appreciates, that's going to add to your profits. And that's the simple example portrayed here on table 11.10. A case where you'll be tempted to invest in the UK due to the interest rate differential. So if you're to invest a full year, the UK 3-month Treasury bill would give you a 10%. This means you'll be renewing every quarter that Treasury bill, whereas the US Treasury bill for the same maturity will yield just 6%. So investing a full year would give a 4% profit of investing in the UK Treasury instead of the US Treasury, uncovered because we're not taking into account the fluctuations in the exchange rate. And if you decide to invest just 3 months, then it's dividing that annual interest rate by the 4 quarters. So 2.5 for the British Treasury, 1.5 for the US Treasury, giving you an uncovered interest rate differential of 1%. But it's not guaranteed that your profit is going to be 1% if you invest 3 months, or 4% if you invest for a full year, because we need to take into account how much will the pound fluctuate during this period. So you want to do a covered investment, meaning, for example, buy one of the forward contracts to guarantee to lock the exchange rate when you're going to bring back those pounds into dollars. That's what table 11.11 is showing you. So we have that uncovered return of 4%, and then or uncovered return for 3 months, 1%. But if you decide to lock the interest rate at the same time of you do this investment, guarantee the exchange rate 3 months from today, if it's currently selling at a discount, namely of 0.5%, that means that it still makes sense to invest in the British pound because you're going to get a return higher of 0.5% than if you were investing in the US Treasury bill. But it's not the 1%, right? Because the pound is expected to depreciate by 0.5%. So per each dollar invested, you still profit 0.5% more if you were just to stay with a domestic investment instead of doing this international investment. So just highlighting, reinforcing the role that currency fluctuation has on international investments. Lastly, Carabao ends up the chapter talking about good and bad speculation. So stabilizing speculation is the good one, is the type of speculation that goes against the grain. So the market is going up. Stabilizing speculation is betting that the market is going to come down. Or if the market is going down, stabilizing speculation or stabilizing speculators are going to bet that the market is going to go up. Right? So the swing of the market is not going to be as big because there are these forces against the grain. And the destabilizing speculation is the one that exacerbates the swings. So imagine that the market is going up and destabilizing speculators bet that the market is going to go even higher. Or if the market is going down, destabilizing speculators bet that the market is going to go further down. So making the swings much higher. And what businesses like is certainty, which means reduce volatility as much as you can. So that's why they are called stabilizing and destabilizing speculation. Then Carabao wraps it up talking about different careers that one may engage in the foreign exchange market. So you can engage in foreign exchange trading if you work for a commercial bank, for a company, for central banks, or turn into a professional trader, or just using your own personal finances to speculate in foreign currencies. That's all for now.